Okay, good.
Have you been unleashed?
Unleashed.
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 Hello, everyone. Welcome back to the Horizon Advisors Unleashed podcast. This is your host, Andrew Hendricks, back again. Excited for another great conversation with my wonderful partner, Ryan Cuss. What's going on, Ryan?
Wonderful, Mr. Wonderful today, huh?
I'm feeling a little elated this week.
Mm.
Well, might have been a little sluggish yesterday, but the feeling is elated, so we're good. Yeah, it's been an exciting couple days. This is the first podcast post wedding.
Look
So
at that.
I got the ring.
Bling, bling.
Wasn't the first ring I ever wanted. I thought this would be like a national championship ring or
Mm.
something, but I didn't make it to the athlete status. So or maybe a Super Bowl. But
Marriage is always a good
marriage is
thing.
always a good thing. But it was a great time. Ryan was in the wedding party, which was great, and the other partner that's always on this podcast, Alex. His kids were the ring bearer and the flower girl. So we keep the family close, and everyone was involved, which was great. And it was a great day, great time. So still a little bit of recovery mode since it was a couple days ago, but we're back at it again, and we don't let it stop us. So it's gonna be an exciting time, and look forward to the future.
Do you feel different at all now that you're married? I mean, you probably shouldn't, but
No, not really. Other than the fact of just changing titles, right? When you introduce people, like father-in-law, mother-in-law, brother-in-law, sister-in-law, wife, right? Those are used to be girlfriend, fiance, my fiance's dad, or stuff like that,
yeah.
right? So now it's kind of just. Other than that, this ring is gonna get a little getting used to. I definitely play with it,
Oh,
more than I want to. Then if it's hot out or cold, whatever, it's like it's a little loose and then it's tight. And so other than that, no, it's pretty much the same. So, which is a blessing and a good thing, and very happy. So, um, it's an exciting time and next stage of the journey of life, and we're here for it. So,
yeah, it was an awesome wedding.
yeah. Thanks for being a part of it. Thanks for the help. Um, we want to talk today. We're kind of going back to a little bit more financial today. Obviously, we do a lot of topics and a lot of different avenues of life, and we wanted to kind of get back to some of the financial matters. There's a lot going on right now in the world of the economy, the financial markets, et cetera. We have basically the Fed's decision is actually it's coming out today, the day we're recording this podcast. But that's a big decision for the rest of the year that everyone's been waiting on. Is every time the Fed speaks, what's going to happen? We have a presidential election, right? That's coming up here in several months. That will be a big determining factor of long term of what's going to happen in this country. So that's kind of stuff, and then obviously we have a lot of stuff going on geopolitically. And when you mix all that in, right, and you speak a little bit more high level, some of the topics that we're constantly talking about or being asked about um, is market volatility, which is a common theme, right, for a better word, in our industry and in the world of finance. But tackling that with navigating inflation, right? I mentioned the Fed a little bit ago. That is really one of the biggest ticket items on their agenda. Their docket is talking about curtailing inflation, getting it down to that 2 number that they want it at or near it at, and what's kind of been happening. And when the CPI comes out and all these different trends and indicators, how that's related to what ultimately their looming decision will be and how they're feeling about lowering rates, keeping them the same, hiking them, again, stuff like that. So there's ultimately, the point of bringing all that up is that there's always a lot going on. We've had conversations, we've done podcasts before about ignoring the noise, and the fear and some of the stuff that's out there that is very easily and readily available to you because it's constantly there. It's the stuff that gets clicks. It's the stuff that people talk about. When things are going good and green, people might talk about it, but it's nowhere near as brought up or as discussed as when it's the opposite and you see the big fear red, markets crashing, blah, blah, that kind of stuff, or the interest rate environment, inflation so high, it's causing, that kind of stuff is what gets the clicks, and that's what gets people talking. Not as much as the green. It's just like in behavioral finance, when people, they hate more the feeling of losing half, right, your money, for example, versus the elation or the positive feeling of if you made half your money. That emotion on the former side, which is losing, feels a lot more painful. It's all kind of tied into all these kind of behavioral trends. So we wanted to focus on some of the strategies and some of the conversations that we have talking about these topics, and how you can navigate through these trends, through these time periods, with confidence, which a lot of it has to do with, again, staying on the ship, staying on, on the course, and which we'll talk about. But we'll go a little bit deeper, and kind of define, what that is and what it looks like. So, the first thing we wanted to talk about is those two items, inflation and market volatility. And what exactly those are, we talk about all the time, and then, we go down rabbit holes of things that relate to them, and again, behavioral finance and some of these other things. But what do they actually mean? Like, what is inflation, right? So, I'll toss that over to you, Ryan. I mean, how would you define inflation?
I mean, I think there's a lot of categories that inflation can be applied to, but I think of inflation as a upward pressure on the price of goods and services. What used to cost 25 cents 10 years ago now costs $1. So, things get more expensive over time. So when we're in inflationary periods, those are typically times where things are just going up maybe at a faster pace than the averages. And it puts pressure, on the system ultimately. And, right now I see, a lot of inflation pressure probably on products and services that you use every day, going to the grocery store, going out to eat, things like that. And then, you know, when cost of goods, go up in price, a lot of times, the big corporations just pass that down to the consumer through higher prices. And we're kind of seeing, some wage battles out there too. Now that things are getting more expensive, that minimum wage or that income you're making doesn't go as far, if things are going up in price faster. And then it puts pressure on wages that, it kind of goes back and feeds right back into pushing the cost of goods up because, if now your labor to create a widget is, more expensive, the business just kind of passes that down to the consumer ultimately.
Yeah, and that's a good way to define it. I always like examples too, and there's a lot of ways you can look at inflation. You can look at it simply, which is just like what Ryan said about the 25 cents now costing $1. Like that's kind of just a simple example of, hey, you bought a candy bar back in the '90s and it was $1, whatever it was, and now that same candy bar is $2, 2.50, whatever it is, right? That's a simple way to look at it. But when you go deeper, kind of like what Lil talked about, you have to factor in a lot of the things that are going on right now that are causing this to happen. I'll give you an example. Rent, right? If you're renting out there, think about why rent is going up or how inflation is impacting rent, right? It's not just the simple fact of, oh, things are costing more, so rent's up, right? You have to look a little bit deeper. And when you find that, you can find out that, well, because interest rates have increased significantly over the short term that we're talking about, and the long term interest rates are still reasonable, but in the last 5 to 10 years, interest rates are high in that time frame. So what did that cause? Well, a lot of people were locked in mortgages, right, in their houses at very low rates. So now if they were either to cash out refi, sell their house, move, buy another one, right, they have to get locked into a new mortgage at a higher rate, which would obviously impact their cost, how much they can pay, their cash flow, their monthly payment, right? Well, if houses aren't selling as much because the inventory is low, because people are staying in their houses, well, what about all the people who maybe are coming out of college or had to move or other things? Well, there might be now a higher demand for apartments, for condos, for things like that where you have to rent. Well, what happens when you have lower supply and higher demand? Prices go up, right? That's more of an economic type of example, but that is also contributing to some of the inflation measures. So when you factor in all these other things with money that got pumped into the market back in, during the COVID pandemic, all that money that went out to us, the consumers, and then into the markets, into the money supply, right? That caused inflation to happen. And all those factors are impacting some of these things. Just like Ryan said, if a widget to make something is now costing more, then the company selling that oftentimes will then flow through that cost increase that they have to pay to make their device or whatever it is now down to the consumer. So they have to pay more so that the business can still be profitable and they can net out the results that they want. So there's a lot of ways. The point is there's a lot of ways and a lot of examples where you can dive into what is impacting the inflationary trends right now. You can also look at the fact of just that there is a lot of money that has been pushed out. There's been a lot of money on the sidelines, and consumers are still spending relatively strongly. Well, when money keeps flowing around and goods keep getting bought, that also will impact inflation. So again, all these little things, you can dive deep into that. But those are some of the examples and some of the things that have happened over the last couple of years that have caused inflation to get where it's at. So typically, again, I go back to the Fed when we're talking about inflation. Again, there's a lot of factors in play here, but if we're talking high level, one common method that they use or have used as a monetary type of policy to fix inflation if it's high is to raise rates, right? Because then rates are higher, people maybe aren't borrowing as much, whatever it is, right? There's a lot of, again, factors that go into play there, and then that will hopefully, in their eyes, slow maybe down the economy a little bit, slow down the environments of spending so that those prices will naturally come back down. That is one of the goals of the Fed, is to maintain a proper level of inflation. And so that's been something that's been hard to deal with based on the recent trends of what has happened over the last couple of years. So again, you can look at it in different ways, but ultimately inflation impacts people differently. You can talk about inflation in all these different trends and ideas, but it really depends on what the consumer is spending their money on, because certain sectors, like agriculture, or you go into the grocery store, Ryan mentioned like the eggs, carton of milk, those things, those might have seen bigger inflationary prices due to many reasons, unforeseen reasons, or things we didn't talk about, and that got flowed through to consumer. Well, there's other inflationary trends where things that haven't had as much impact. Like
A lot of electronics are going kind of down
down.
in price
Mm-hmm.
overall.
I mean, think about it. Like if you look at, if you buy a video game for your child, or you buy a video game for yourself, and you look at the price of a brand new video game, 5 years ago till now, has that changed a whole lot?
Sneakers, yeah, I
No.
know my daughter, she buys, $100, $150, type sneakers. Well, I know, when I was a kid her age, sneakers cost the same amount.
Mm-hmm. So you look at that and go, well, has there really been a strong inflation trend there? So you'll always be able to find certain sectors where it's not that they're immune or it doesn't happen. It certainly does both ways, but there are certainly certain um, areas of the consumer spend that have felt it more painfully than others, which is why, wage based and other things, all these things start to come into play. Um, and it has a rippling effect, a domino effect per se, on these areas. And ultimately, it does lead. It's not directly per se correlated to the markets, but you can look at all of these trends and you can start to see some of the things that are impacting some of the volatility out there. I mean, again, I go back to the Fed. If you watch the markets on a daily basis like I do, every time the Fed decision is looming or they think something's going to happen, the market has a pretty big sway one way or the other, at least from a daily perspective, because the market's feeling, you'll see the headlines, the market waiting the Fed decision, and they feel like they're going to pause or hike, and then that's maybe hurting the market or whatever it is. Or the opposite, the rumor is the Fed's going to lower rates or whatever, and then the market spikes in the positive way, right? That's not always what happens, but you can start to see these things because these decisions do impact the long-term outlook or the short-term outlook of the analysts, these big companies out there that do this right on a daily basis for a living. And that does, again, and then affect the market, which can cause volatility. And although the market over the last couple years, really since 22, it's recovered from that kind of hurtful 2022, which was the worst year since 2008. We've recovered since then, but it's been volatile, right? Depending on when you got in, if you put new money in or whatever, right? You could be still relatively flat. You could be up big time, right? If you bought into certain positions and right at the very low in 22, or maybe you're still kind of at a wash because you were invested longer term and you felt both of those swings. You felt the down in 22, and then you felt some of the up in 23. But that's what ultimately market volatility is, right? We defined inflation in a little bit, and I'll push it back to Ryan here on market volatility. I kind of gave a little example of that. It's kind of like a hill or a roller coaster, but how would you define market volatility?
Yeah, I mean, if the market just went up, then everybody would be in it. Everybody would stay in it. There would be no movement because it just goes up, and it's the volatility that I think makes people sell or buy stocks. In the history of the market, there's always been a lot of volatility, and sometimes there's more than others. I think right now this year we've seen some volatility, nothing that's been too painful, but leading up to the presidential election and everything that's going on, I suspect we'll continue to see some market volatility until we know what's going on. Once the president, we know whoever it is, it doesn't really matter. I think just once everybody knows who the president is, it'll calm things down a little bit. Once everybody feels confident with inflation that we're making great progress, we've already made progress, but that everybody has the confidence that we've won and things are going to get better. Again, that creates confidence that typically reduces some of the volatility out there.
Yeah, I mean, volatility does stem at the end of the day, disregard financial markets. When you hear the word volatility, if you relate it to anything in life, usually volatility stems from like uncertainty, right? It stems from the feeling of not knowing what's happening, not knowing what's going on, right? If things are volatile, right, it means it's sporadic. It's kind of going everywhere. It's going left, right, up, down, diagonal, right? There's no trend per se to it. That's really what volatility is it goes up, it goes down, and then it goes down again, then maybe up twice and back down 3 times, right? That's what volatility is. When things are more calm, it's either they're going down in unison or they're going up in unison, right? That's more of a when it's less volatile is when you see a trend for a certain period of time where it's consistently going up or consistently going down, right? So I always relate market volatility to a roller coaster, right? You go up, you shoot down the first big hill, and then you go up another little hill, and then back down the other hill, and then maybe up with the speed, you go up another big hill, but then you go back down, maybe a smaller hill and coast down a little bit, right? There's just no necessarily prediction to it other than it just going in directions that are, sporadic. And again, that does come with the buying and the selling when we're talking about financial securities or the financial markets. That goes with the buying and the selling of those positions. That's where it comes from. So, some of the things to kind of further this conversation after, we've defined it, would be, some of the conversations we have on strategy or what we do to combat these trends, these subjects. And it's not that these ideas or these strategies are like a end all be all solve for everything, because that's not how it works, right? You have to have a strategy that is sound and you have to be confident in the strategy. But just like the financial markets, things go up and down all the time. So at the end of the day, diversification, right? That is the biggest thing that combats these trends. And that's because in certain times, different asset classes perform differently in periods of high inflation, periods of low inflation, periods of no inflation, periods of high interest rates, low interest rates, all these different factors, right? Cyclical type of companies perform differently during seasonal type things, right? So there's all these different impacts, but that's why diversification of investments in your portfolio. And when I say portfolio, we're talking about your balance sheet here. I'm not talking about an investment portfolio specifically. That's included there, but I'm talking about real estate, personal assets, investments into securities like stocks, investments into securities like bonds, investments into alternative types of things like commodities or private equity or venture capital or private credit, private debt, right? All these things. There's so many different things you can invest in, and that's why, again, all those different asset classes perform differently when the trends are in these different times. So when you are diversified, you are invested in a way where you will be in, probably unfortunately in some asset classes that are perform poorly maybe during trends like this. But then maybe those asset classes perform very well the next year because something changes and then they outperform everything else, or vice versa. And with proper rebalancing, which is another one I wanted to talk about for the strategy here, you can continue to rebalance and reallocate your portfolio back to where the percentages that the strategy accounts for. So you're rebuying in at the lows for those positions that went down, and you're selling at the highs for maybe the positions that went up, and you're rebalancing back to where the proper state. And data does show that rebalancing is a very important piece to combat some of these trends. And again, it's like when you look at your balance sheet, right, I said portfolio, but when you look at your entire financial situation, diversification really is a big piece of it, because sometimes when interest rates are high, cash might be a good solution to keep liquid and get a good yield from the bank, right?
Yeah. I know one of the strategies we've been watching a lot this year, and we've been hearing it from a lot of the experts, is looking at the duration of bonds that we're carrying in the portfolios that we managed. And not that we ever sway one way or another, we're always diversified, but at the end of the day, one of the things we're leaning pretty heavily towards right now is more short-term bonds. And I think that's going to be a pretty nice place over the next 2, 3, 4 years. Kind of what we're outlooking, to keep it shorter duration. We don't want to make bets long term on where interest rates are going to land, yields are going to land, because those impact the bond prices. So that's one of the areas, the strategies we've been focusing on, is looking at what we're carrying for our fixed income in our portfolios, and we're leaning a little more on the short side right now.
Yeah, and just to clarify there, the length of the maturity of a bond and duration are different. They are related to a degree, but they are actually very different in regards to what we're talking about. So, shorter duration bonds can be less sensitive when interest rates increase, right? So, like if you were, kind of speaking to Ryan's point, like the last, couple years while rates were going up, short duration bonds might have been a good solution because they don't feel as much pain as longer durations do. But now that we're in the situation that we are in, and interest rates maybe, hopefully, have peaked for the time being and maybe will be coming down, then maybe that's when you pivot, and maybe extending the duration actually makes sense, because those duration bonds are going to be more sensitive to the price change as interest rates rise or fall. So if the hope or the expectation is for rates to fall, well, then maybe now, if you've been in a shorter duration period, maybe extending them now makes sense, right? So these are some of the ways that are, from your diversified portfolio, this is some of the ways that you can kind of combat, some of the things out there and some of the trends that are going on. And if you have a proper outlook and a proper strategy and working with a proper team, that's their job to look at those trends, understand those trends, and then try their best to their ability to combat these trends as much as possible. So that's a great example on bonds is, again, the duration, either shortening it or extending it. The maturity of the bond matters too. But that's one way, is looking at the time horizon and allocating for that. A couple other ways you can diversify, that was kind of specifically more on the bond side, but, just in general, right? A very common diversification tool that people forget about is geographic. One of the things that we see right now is the U.S. has been a killer.
It's been on fire.
It's been a train, that's done very, very well. And the domestic markets have performed well over the last year and a half. So when you look at that, you're looking at, okay, That's domestic US. Well, that's in one geographical location. That's in basically North America, right around where we are. But what about what's happening internationally? Right? So there's a lot, I mean, there's so many
China,
other investment
India,
countries,
Mexico,
exactly. The UK, right?
Japan.
Africa, all these places that are international that, those markets have not performed as well over that time frame that the U.S. has. So when you look at the price disparity of where you look at opportunity wise, where maybe the opportunity is, you have to pose the question of should there be some international diversification? If you haven't had it, you might be considering it now, or if you've had it, you've probably seen a little bit of a more recently a little bit of a nice trend there. But over the last 5-10 years, international has not performed as well as the U.S. has. So that's another way to diversify is investing in other countries, other companies that are based not in the U.S. and see what they're doing and looking at the global markets and seeing if that's an opportunity for you and your portfolio. Obviously we talked about asset diversification. That's the most common that people know, right? And that's just the basic stocks versus bonds, right? Or versus real estate, asset classes. But sector, right? That would be another one that that consider to combat these things. Because again, all these sectors, not just the asset class, but when you dive down into the sector itself, also your sectors perform differently, than other ones, right? And that could be looking at, the healthcare, right? Healthcare system, right? You can invest in that sector, automotive, cyclical stocks,
Technology.
technology, agriculture, things like data management and cloud, like the cloud management of data, AI, right? All these other areas are when you dive even deeper, and then you diversify even further by, maybe the certain sector is performing very well in these trends, and the other ones aren't, right? You saw what happened in 2022. Interest rates rose very highly. One of the biggest sector per se that got hit the hardest was tech. Tech's also been one of the ones where in high expansion growth periods that they perform very, very well historically. So, that's also the layer of diversification that you can take is, the different sectors amongst all these other things that we mentioned. And you can go down a rabbit hole with this. And sometimes it's even, you get paralyzed by the analysis, right? But even geographically, right? If you start there, then you go down geographic asset classes, and then you go geographic asset classes sectors, right? And you can do that with a lot of different things. So the bottom line is that diversification, from a high level, is really truly one way that you can combat these trends and stay the course during times of uncertainty, volatility, high inflation, low inflation.
Yeah, we have a pretty cool tool called Y Charts that we subscribe to, and if anybody listening wants to just see how their portfolio is diversified, we can very easily put all the holdings into that software, and it breaks down everything that we're talking about, and provides some pretty good reports and analysis on that.
Yeah, it can also manage or explain the level of risk per se, right? That's another big thing. From a diversification standpoint, at the end of the day, risk is associated with these different asset classes, these different sectors, these different things, right? The bonds, the money market instruments, those things are naturally considered to be conservative investments, whereas the equities and stocks, private equity, those sort of things, those are considered to be aggressive investments. That's the compliant term. Aggressive doesn't always sit well in terms of with
No.
me, at least in terms of how the word sounds, but that is technically how is aggressive and conservative. And so that's also that diversification too, is how aggressive you're getting in those asset classes, right? There's a little bit of a difference between investing in a company that's been here forever, been, financially sound and done very well over a long span of time versus investing in a new company that just IPO'd and is just still brand new to the public. There's still a layer of difference there. And that's when you get small, mid, large cap, mega cap, right? So there's so many ways you can dive into this. And ultimately working with a team that's their job to do. If you can't do it, is how you can achieve, some of these combative strategies on some of these areas and get to the long-term goal. So something we're passionate about, of course. Talk about it all the time. But yeah, take a look. We're always happy to help, and we have a lot of great analytical tools and software to be able to analyze and manage things to see what's going on. And it's a good thing. So inflation, market volatility, two hot topics right now. It'll continue to be so probably for, well, forever. So appreciate you listening, and we'll talk to you again soon. Thanks. And we'll be back again soon. See you guys. Ryan Kuss, President and Financial Planner. Alexander Dinzer, Managing Director and Financial Planner. Andrew Henricks, Financial Planner. Securities and advisory services offered through Cetera Advisor Networks, LLC, member FINRA/SIPC, a broker-dealer and registered investment advisor. Cetera is under separate ownership from any other named entity. Tax planning services offered by Horizon Advisors. Tax and accounting services provided by Horizon Advisors CPA. Cetera Advisor Networks does not provide tax nor accounting services. For a comprehensive review of your personal situation, always consult with a tax or legal advisor. Neither Cetera Advisor Networks, LLC, nor any of its representatives may give legal or tax advice. The views stated in this podcast are not necessarily the opinion of Cetera Advisor Networks, LLC, and should not be construed directly or indirectly as an offer to buy or sell any securities. Due to volatility within the markets, opinions are subject to change without notice. Information is based on sources believed to be reliable. However, their accuracy or completeness cannot be guaranteed. Past performance does not guarantee future results. Investors cannot invest directly in indexes. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and the fees and expenses associated with investing. A diversified portfolio does not assure a profit or protect against loss in a declining market. All investing involves risk, including the possible loss of principal. There is no assurance that any investment strategy will be successful. Distributions from traditional IRAs and employer-sponsored retirement plans are taxed as ordinary income and, if taken prior to reaching age 59 and a half, may be subject to an additional 10% IRS tax penalty. Converting from a traditional IRA to a Roth IRA is a taxable event. A Roth IRA offers tax-free withdrawals on taxable contributions. To qualify for the tax-free and penalty-free withdrawal of earnings, a Roth IRA must be in place for at least 5 tax years, and the distribution must take place after age 59 and a half or due to death, disability, or a first-time home purchase, up to a $10,000 lifetime maximum. Depending on state law, Roth IRA distributions may be subject to state taxes. Investing in mutual funds is subject to risk and loss of principal. There is no assurance or certainty that any investment strategy will be successful in meeting its objectives. Exchange-traded fund and mutual funds are sold by prospectus only. Investors should consider the investment objectives, risks, and charges and expenses of the mutual fund or ETF carefully before investing. The prospectus contains this and other information about the product. Contact Alexander Dinzer at 5455 Corporate Drive, Suite 306, Troy, Michigan, 48098 or 248-265-6662 to obtain a prospectus, which should be read carefully before investing or sending money. Horizon Advisors, 5455 Corporate Drive, Suite 306, Michigan, 48098.